Hello, good evening, everybody.
Good evening.
Welcome. Welcome, TCL. Ken, we have Hin Min Pang, Daniel Tu, 𝐀𝐟𝐿𝐴, �YFCO, Adil, Seng Teh, Wendy Wong. Welcome. Thank you for joining us tonight, right? And the rest of you guys as well. Okay, well, we're still waiting for the others to join us. Just gonna go through a few announcements before we go and start our session for tonight, right? So tonight is gonna be about investing for those who are still new in stock market and do not know where to start. And we're gonna do a few comparisons of the products offered by Bursa Malaysia, right? So Alvin is gonna guide us through most of the time, and we'll basically get your questions as well. If you have any questions at all, you can just type in the comment section so that we'll pick up the questions and we can answer them. All right.
Okay, cool.
Okay, so first of all, welcome once again, and we are glad to have you guys here again. This is a continuous session from a Bursa Malaysia e-learning, right? And of course, this whole webinar is brought to you by Bursa Malaysia. So today's title is going to be about investing for those who are still new, how to make it simple, fast to start, and also affordable. All right. So today we have Alvin with us. We can get the details later, and we'll, if you want to get the slides, we'll also share with you later on after the webinar on how you can get those slides for today. All right. And of course, yours truly, I'll be on together with Alvin to also do the presentation for today. All right. And first of all, if you have any queries about Bursa Malaysia products, you can always go to bursamalaysia.com and also bursamarketplace.com. And Bursa Malaysia has also just introduced its new e-learning portal under Bursa Marketplace called bursaacademy.com. All right, so you can go there and get more information. So before we start, whatever that's being shared here and discussed here today are based on informational and educational purposes. It's not intended as any investment advice, right? Should you look for investment advice, please seek for a professional or licensed investment advisor. All right. Okay, so I'm gonna leave this to Alvin to share with you because he has prepared the slides. So I'll just join in to do some additional stuff if you guys ask, right? So please do ask any questions if you have right now, and then we can answer them. All right. So Alvin, over to you.
Thank you. Good evening, everybody. Welcome to tonight's session brought to you by Bursa Malaysia. Now, actually, when we were thinking about crafting this topic, really, I'm trying to answer what questions that get asked quite often to me. Either you're a beginner or beginner. You can start at all ages, right? So a beginner could be in their 20s. A beginner can also be in their 50s, right? And today I actually really want to tackle that question. So instead of just talking about the product specifically, tonight's session are going to be centered around two products. We talk a lot about stocks all the time. In the first session on Bursa Malaysia's this e-learning for 2020, we talked about how to become a data-driven investor. Right, it went through economics. We went through it. So if you missed out the video, you can go and check it out. The tonight's session really is centered around two investment products, so they call it ETFs or REITs, right? And I hope you stay to the end. We do have something to share for you at the end. There's a takeaway for you at the end. And if you know anyone who's new or who actually just started, right, you can share this video with them as well, because I believe this will be very helpful for them. All right. So this is a very quick disclaimer that like I think what Benny already mentioned, this is not financial advice. This is purely educational purposes, and we are on every Saturday, right? We're gonna be on every Saturday night, same time, for the next 9 weeks, right? 7 was this is the second episode, so 8 more weeks, right? That we're gonna be on, right, Benny?
Yes. And if you have missed last week one, you can always view the video back last week on Saturday. So this is recorded and it's on our Facebook and also YouTube page. All right.
Yeah, and also on Bursa Academy as well. Okay. So now let's talk about let's just talk about general now. So we talk about what, if you have a trading account with Bursa Malaysia today, which I believe most of you guys who are watching it, we still don't have one, go and set one up. It's very easy to set up, right? And you once you log on, what you actually have access to is what we call stocks, which I think almost everyone here is very familiar with stocks. The second one, I think probably less popular, is actually exchange traded funds, and I think we get asked a lot of questions about what it is, and I think there still needs to be some sort of education around exchange traded funds. I think the third one is generally people are quite familiar with what they call REITs, real estate investment trusts, right? And of course, the last one, I'm putting it in very general terms. I call it derivatives. It could be warrants, it could be structured warrant. It could also be futures as well. All these are actually bundled under derivatives, right? Now, when we talk about a introductory session like this, right? I guess the main question is, I think generally most people, when they think about stocks, they think, oh, it's very risky, right? And if you look at perceived volatility, so I want to talk about volatility. That means how much the stock moves up and down. You're actually going to be looking at if you measure the price swings, right? You're going to say that stocks generally can be high, right? Now this is very perceived volatility, right? The perceived volatility of exchange traded funds is low. Real estate investment trust is also low, and derivatives is high. Okay, now there's a very key differences between them, why you actually want to pick them as an investment product, right? If you're buying stocks, you are essentially buying a business, right? You are essentially putting your money against the CEOs, the board of directors, and the business model. They actually manage the business. So I call them, in very general term, business managers. So if you're investing in stocks, you're investing in a business, right? Not share price. I think a lot of people look at share prices only. The second thing, if you're investing in an ETF, you are actually getting a fund manager to invest money on your behalf, right? That's why they call exchange traded funds. So fund managers run the funds, right? The third one is actually what we call REITs, right? REITs are essentially run by property managers, right? So the big difference between exchange traded funds and real estate is that they are both run by fund managers, but one manages property, the other person manages ETFs. Okay, and of course the last one, when we talk about derivatives, right? Who manages it, right? You are the manager. Okay, essentially, because the derivatives is so wide, right? Basically, derivatives are get their prices from what we call a mother share, right, or mother price, right? So in the case of index futures, you're looking at index. If you look at gold futures or palm oil futures, that is the underlying price, which is whatever derivative it's from. So the word derivative means that it's derived from something. That means their price is derived from something else, right? So essentially, you are buying a contract, okay, or an option, right? So we won't go into details for this because it's really just introduction. But if you look at the risk, right? So I think the perceived risk for stocks generally is high. Perceived risk for exchange traded funds is low. Perceived risk for real estate is low, and of course derivatives is high, right? But you see on the last column here, I've actually put let me see if I can get a pointer here. I've actually put here low, medium, high, right? Why do each of these products, or why do each of these classes of investors or assets, why did I put the risk as low, medium, high? Okay, it's very simple, right? Because at the end of the day, whether it's risky or not risky, it actually very much depends on you, right? It depends on no one else. Because if you give someone who is very, very skilled in derivatives, right? Let's say like Benny, right? For him, investing in derivatives is low risk, right? Because he knows what he's doing, right? If you get someone who is very familiar with property investments, right? Or property managers, or specifically each of these property managers, how they're doing, he's going to say that, real estate is low risk, right? If you get someone who's very familiar in stocks, right, and they understand the business through and through, they actually understand the business, what drives the business, and so on and so forth. He's also going to say that stocks is actually low risk. Okay, so it's very much dependent on you, and really that's why we're talking about education, right? Why educating yourself is so very important. All right. So yeah, later we're gonna do a quick poll just to see the viewers, right? So if you just joined us, don't forget to share below, tag your friends below if you think they can actually benefit from watching this segment. All right. Now, so actually I'm going to start off the introduction very simply, right? Actually, I'm not going to talk about stocks. I'm not going to talk about any products, right? Really, what we're looking at. So what I've done here, I don't know if it's too small. If you guys can see, I've actually put down what I call a personal lifeline. Okay, so from year 0 when you're born all the way to at some point in time, if we live, let's say, like general, I put very extreme life expectancy, let's say 80 okay. I can tell you my personal experience. My grandfather passed away at 55, right, or 50, 52. I know my grandmother lived till ripe old age of 93, right? So no one really knows what every individual's life expectancy is going to be, but generally in Malaysia, I believe it's 74 for men and 76 for women, right? So women outlive men, right? That's the statistic that we have. So I just put it very simply, from 0 to 80. Let's assume that you are 0 to 80. Where are you actually right now? Which stage of life are you at? So I've put it into 8 intervals, right? So 0 to 10, 11, 20, 21 to 30, 31 to 40, and so on and so forth, right? Okay. Which segment are you actually in right now? Okay. So I'm actually in this segment here, right? Now what is the reason why I'm doing this? Okay, because what product you're gonna pick, essentially, it's gonna very much be dependent on your investment, right? It's going to depend on what stage you're at. Okay. And I'm going to explain to you in a short while. I've got a couple more slides to give you an idea why I'm talking about this, right? So put in the comment below, if you are okay to share which segment you are at. Okay. Now I put 12.5%. So I'm assuming that if you live to 80, that's how much time each decade represents of your total lifeline. Right? Each decade, that means every 10 years, what does it represent of your total lifeline? So if you add up 12.5% all the way through, it's going to equal to 100%. Now, regardless of whether you're rich or poor, right? All of us have this standard lifeline, which is time. That is the standard resource all of us are given, right? Some have given more, some have given less, but we'll never know when it ends, right? But every decade, if you live to 80, represents 12.5% of your life, right? So if you are about here, you've used up 50%. Okay. That's assuming you live to 80. And this is very factual, right? You've used up 50%. So what are you gonna do with the next 50% of your life, right? Essentially, that's what I'm talking about, right? And if you think about this, this is very much personal. So you can see that I actually use my pen and kind of scribble on it, so you guys can actually see. If you started work, when I say, if you have active income, that means you work for yourself, or you are actively, that means you have to work to actually generate income for yourself. Let's say I put very general terms here. You started at 20 or 21 and you retired at 60, okay? For active income, okay? That is effectively 50% of your whole life. 50%. Okay. And I guess you can go and Google this, and a lot of people talk about you should be doing stuff that you like to do, right? Because effectively, if you're in a job that you hate, that's 50% of your time in your whole life that you're gonna be feeling pretty miserable, right? So what is very important is do what you like. And if you look at this sort of time frame, this is actually will also relate to your income level. So now I'm doing a very general one. Some of it may apply to you guys, some of it may not apply, okay? But I'm just trying to illustrate what we're trying to do. Now, what I've actually drawn up here is what I call your income line, okay? So I'm assuming that by the time you're 20, 21, you actually start earning income. And I think you can go and Google this. Is quite common. You actually can draw your own income or income line really, and it'll be great exercise after this session if you guys can go and draw your own income line. But this is really for illustrative purposes. Now, assuming that if I start work at 2021 and I start working and I get paid more over time, and let's say at 60 I retire, you're gonna see this sharp drop immediately. Okay, and I'll come to why I'm going to talk about this, right? So you can see generally your income should go up over time. Active income, this is working income, not investment income, right? And after you retire, this is really what it looks like. Okay, now then what I tried to do is actually illustrate to you what I mean by expenditure. Okay, so expenses, so this is very personal, right? So if you start off life, you know expenditure starts the moment you are born, right? The moment you're checked out of the hospital, that's your hospital bill already, right? For most parents, I think you can relate to this. And really until you actually work, depending, I just put a very general line expenditure. It can go up, it can go down. But generally, this is where your parents come in very handy because they bridge the gap between your expenditure and your income, right? So this is really what you are actually spending. Now, the moment you actually start working, the whole idea here. Now, this may not apply to everybody. The whole idea here of being prudent is that whatever you earn, you should spend less. Okay, but we know now, I mean, just purely looking at household income, I can see that, generally, I think more people spend more than what they earn. So actually, your line may be inverse. Okay, if your line looks like this, fantastic, right? Good on you, right? Because right now in the modern world, there's just so many distractions. It's that new iPhone you need to get, that new car you need to get, that bigger house that you need to get, and so on and so forth. So generally, I'm tracking mass population. As your income goes up, your expenditure also goes up. Okay. Now, what happens is this: expenditure never really drops, unfortunately. Right? You're gonna see I illustrated by putting a small dip here, and then going back up because. After you retire, the kind of expenditure you'll be spending is going to be very different from before you retire. Okay, and this is very much what I call inflation and medical. All right, so we wish that this one can also drop down to zero, but it's not possible. Okay, so imagine this, right? We're trying to use all this here in between to actually sustain us for this period of time. All right, you tell me whether that's realistic or not realistic. Okay, now. Let me go here. Okay, now I'm putting the most typical average person, right? It may not relate to you because you are here watching this live, right? Generally when you're 0 to 10, 20, 30, right? They got this term called you only live once, right? So we tend to be a bit more carefree. I'm still young, still got a lot of time, right? And I call it YOLO, right? You only live once, and we're quite carefree with that spending without really thinking about investment. And we get a lot of this, and that's why I'm trying to illustrate this, right? Now here is what happens to the danger zone. This is what I call the danger zone. The moment I see when people come and chat with me or come to some of my classes, they are around this range, right? They realize at 38 or 30, when you're 38 to 40, 41, that seems to be what I call the danger zone. They realize that they are only 15 years away or less from active income. That realization just pops, right? I call it the OMG moment, right? And here is where why I call this the danger zone, because actually I'm going to talk about risk in a short while. The danger is this. The danger is that they suddenly feel that they have not much more time in their active income. And what it then gets them to do, they start thinking, oh, I need to make money fast. So let's look at the stock market, right? I need to make money fast. I need to catch up for the last 15 years. I only got 15 years of active income. Whatever savings I can, then I always see them go into Forex, leverage play, and do all sorts of risky things that I don't think is actually necessary to do, right? Because if you think about 41 to, let's say, even 65, you've got easily 25 years there. You don't have 15 years, right? And this is where I want to caution, because if you are at this stage and you are thinking of going to stocks because you realize you don't have much more time and you need to start creating a second income, take a back seat and sort of understand it before you actually jump in, because it can end quite disastrously. All right. Of course, the next segment after that, when you're 55, then most people think, you know what, I'm close to retirement. I don't have I don't have any more time to invest, right? But if you really think about this, at this point, right, you actually still got another 50% of time left in your whole life, right? And I'm being very objective about it, because that is, if you live till 80, that is the time frame that you have, right? So the whole idea here is, if you're in an OMG situation, or you think it's too late to invest, right? I hope at the end of this presentation, you might rethink that. Okay. For those in your YOLO, you only live once kind of category, please think seriously hard about your future, because if you're in that segment, the great news is this: you have a lot of time, right? And here is where I talk about that risk taking, right? So generally, we find these guys here don't really start. The interest about investing is not high, because the need is not there yet. Okay, or they don't see the need. But I can tell you, almost everyone would head to that path, right? What happens is that during the OMG moment, is that the blue line represents what you can afford to risk, and the red line is what most people do, which means that when they hit the OMG moment, they straight away increase their risk-taking ability, right? Even though they're not risk takers by nature, they realize because they're short of time, they do extremely risky things. And this is where a lot of times disaster happens, right? So I also hope that none of you guys are in that situation. Please don't take unnecessary risks, right? Okay. What I want to highlight to you is this, right? Regardless of where you're at, understand this: you have your active income, which is your lifeline, right? It's almost like a parallel dimension, right? You also have another lifeline, which is your investment lifeline, right? Of course, they are in exactly the same space. But what I'm trying to say is that just because you have active income doesn't mean you must ignore your investment income. In fact, the earlier you start with your active income, the better you're going to be by starting off your investment income as well, because investments will take time. Okay. And if you're young, time is really your greatest asset at this point in time, not the cash you have in your bank. It is the time. Because imagine someone in their 60s, they'll say, oh, I look at you, you're, let's say, 30 years old. I'm saying, wow, you still have so much more time left, right? And unfortunately, time is not something you can buy back with, right? So what I think most people should be doing is really be experimenting at this age, right? Which means get interested in finance, get interested in stocks, get interested in investing in general, right? Arm yourself with knowledge, right? You're gonna fail. You're not gonna succeed the first time. You might fail, and that's okay, because you still have time to recover. But what you should never do is never not start, right? And I'm saying use that time to experiment and learn, and really take this period to seriously invest, because I believe this is your very much a good investment period that you actually can invest. And if you look at this, this is almost 40% of your lifeline, right? So they actually run in parallel, and that's what I'm trying to say. So don't take unnecessary risks if you don't have to, all right? Of course, if you agree with me with this OMG moments, or if you've ever had an OMG moment, comment below. I also want to know if you guys hit that that point in your life, right? Okay. And I'm trying to tell you not to do crazy things. Okay.
Yeah, I guess the OMG moment will be bigger if you got more kids as well, right?
Oh yeah.
Yeah, I guess the keyword that you mentioned here was, I mean, if you go back to the last slide, was invest, right? Like you said, a lot of people tend to take more risk once they hit that OMG moment. That's when people start to go and trade very high risk products to get high returns. And you know, most of the time we get people, you know, when we talk to people, they always ask a question: do you play stock market? You know, or do you play this market, or do you play, you know? I mean, investing is not playing, right? So you really need to be serious about it, because it's your hard-earned money, right? And the only way to do it is basically to equip yourself with the necessary skills and knowledge, right? And to be a well-informed investor. And this is what this whole series is all about, right? Is to make you become a well-informed investor, so that you treat investment more seriously rather than just play, right?
Yeah, that's right. There's no playing. You gotta take it seriously. No, you want serious results, you gotta take it seriously, right?
Yeah.
If you gotta take anything like you gotta kind of play with it, then you're not gonna get serious results, right? In anything that you do, I think, if you ask me.
Yeah, so the next part is the next option, right? Especially if, let's say, you are still new. So the next segment, Alvin will now basically share with you what are the products available that you can actually invest in Bursa Malaysia. Because, you know, we have actually, I mean, Bursa Malaysia has not only just stocks, right? They have other products which is available for any kinds of investor, depending on your risk, depending on your levels of knowledge and skill as well.
Yeah. So really, I think before we even, I mean, the whole idea, if I just purely talk about products, I think that's going to be pretty boring. Let's look at what products can actually apply to you at whatever stage in your life that you're in. Yeah. So, you know, again, these slides are available for download after this session. So I will send you guys I've sent you guys a link, right? So do check it out. But I won't be reading off my slides, because you know, that defeats the purpose. But generally, what I want to just share with you is that ETFs are effectively funds that you can buy on the stock exchange. That's it. Okay, and just like if you are familiar with buying funds or unit trust funds, for example, they have different themes to each fund. It's a theme, right? So are they you know, growth stocks, growth investing, or is this a dividend play, or is this an overseas play, or let's say a China fund, or Brazil fund, or US fund, right? Or technology fund. So each of them have their theme. It is actually exactly the same, except what is the biggest difference about ETFs is this, right? They offer you a lot of convenience, right? I'm not gonna, you know, some of them talk about fees and everything else, but I think to me as an investor, what actually ETFs provide you is actually pure convenience. So you are paying for convenience, and it's very easy to monitor them, right? So which means someone else already do all the work for you. You just literally almost got to sit back and relax, right? Depending on your strategy. Okay. Now, what was interesting about ETFs is this, right? ETFs is not exactly very new. So, you know, this is very much introduction to ETFs. And if you think about this, right, the first attempt at building an ETF was actually back in 1989. Okay. And that was on the S&P 500. Okay. And you know, back in those days, in the US, actually the one of the federal courts actually deemed it, they couldn't deem it as a security, so they deemed it as a future instead, right? Much to the frustration, right? Actually the first actual modern ETF that we know today was actually listed on the Toronto Stock Exchange, right? In 1990. I think 1990, I believe, right? Toronto Stock Exchange. And ironically, they tracked the Toronto Index, okay, also known as TIPS, right? So the ETF was actually called TIPS 35, right? I believe it's still around today. Now, for those of you who are familiar with the US market, I think you would definitely know this. In 1993, this was the first modern ETF in the US market. It was actually to match the S&P 500. Okay, it is called SPDR, or short for SPDR, but the short code for it is SPDR. I think most of you guys are familiar with that. And they actually track the S&P 500 stocks, which means that this fund will only buy stocks in the S&P 500, right? So imagine for yourself, you don't have to go and buy 500 stocks. You may not even have enough money to buy 500 stocks. Is that you buy into this fund, and this fund will pull all the money together and buy all the 500 stocks for you, right? Effectively, it is a diversification strategy To me, it's very much convenience, right? It gives you exposure to a lot of stocks by just buying one stock. So it's almost just to consolidate. Today, that fund size is $253 billion, right? US dollars. So that's about ringgit trillion. Okay, so that's quite sizable. In 2002, after the launch, so it almost took 10 years. If you look at it, it took 10 years. After 10 years, there were only 100 ETFs. And you fast forward 7 years later, that 10 became 1,000. Okay, I just want to give you guys an idea about ETFs, right? And why they are so popular. The main thing is this, right? They provide convenience, right? Now, this is purely only US. US today, on the New York Stock Exchange and Nasdaq, there are almost 2,100 ETFs today. So that's even more stocks that we have on Bursa Malaysia, for example, right? So it is crazy, and I want to give you an idea why it's been so crazy, right? So they won't be launching these funds if no one wanted to buy them. All right. And I'll share with you a bit of history in Malaysia as well, right? Now, what happened here was this. This is the total net assets, right, of ETFs in the US from 2002 to 2019, right? And if you look at right on the top here, you're gonna see that it's 4,396, right? That is how many billion dollars in asset value. So it's $4 trillion of money is actually in ETFs today. Okay, 4 trillion. Okay. Now, if I go, if I just give you guys an idea, right? This is Asia Pacific. Who are the largest ETF providers, right? Nomura is the biggest one. Nikko Asset Management, Daiwa, very much Japanese, right? iShares is actually owned by BlackRock. iShares is actually the largest in the world, right, for ETFs. They're also in trillions in terms of fund under management, right? But just to give you an idea, it's grown exponentially. I think in 2008 to where we are today, about last 12 years, this has grown exponentially. Okay, now, and you can imagine why, right? Because actually, if you think about it, if you don't want to pick stocks individually, you're like, you know what? Imagine this, right? If I am running, I have active income, and like what Benny is saying, I've got kids and everything else. I'm already too busy in my life, right? So can I actually still get exposure in the equity market or any markets that I want to without actually having to actively manage it? That means someone else does it for me, and I want exposure in this and for a very low fee, right? That's why ETFs took off tremendously, right? Because people just kept buying ETFs. Now, but effectively, if you think about it, if you're buying an ETF, you are still buying stocks, right? Because the fund manager will go out and buy all those stocks, right? And that's why if you can see whenever stocks are added or removed from indexes, right, you're going to see, they've also been largely blamed for the volatility. So can you imagine if you are in the S&P 500 and then suddenly, and everyone tracks the S&P 500, for example, there's so much money in there, is that the moment you're taken off the list, you're going to see the share price coming down because the fund managers actually have to sell and buy back the new one. Right, so ETFs in the US have been blamed a lot for massive volatility. All right, I have a question here regarding, from Florence. Do they pay dividends? It depends, right? You must look at the ETF itself, whether or not they pay dividends, right? So it's actually in the prospectus, so you can actually read it, right? Now, let's look at what kind of size we're talking about. Globally, $6 trillion are ETFs. 6 trillion, so it's huge. Okay, and this is of I think 2020. There are about 7,000 ETFs globally, right? So you can imagine this, right? You can essentially buy any ETF in the world today and have access to almost any asset class, anything. Right, it can be gold, it can be silver, it can be palm oil. I mean, it just can be anything, right? Because that's what an ETF is. It is just so simple. It's a simplified way. Of course, this is very much a personal preference. So, like I said, depending on where your timeline is, right? It's what you want to do, right? Do you actually want to actively manage your stocks? If you do, then you can still do that. Then you may not be interested in ETFs, right? But if you just want to let it run passively, or you have a strategy that you put money in like your EPF account, you can also do that, right? So it's really up to you where you are, at which stage of life you are in terms of risk as well. Yeah, iShares is the largest in the world. There's 6 billion US dollars. It's that's in Latin America only, by the way, right? And there are about 2,100 ETFs in the US, right? Right. So and almost every US financial advisor talks about ETFs, right? And if you think about it, in Malaysia, of the, I think, 2 or 3 robo advisors that were launched, all they actually get you to do is buy ETFs, right? So what kind of size are we talking about? I'm going to share with you. This is where you're going to see how big of a shocker it is, right? So this was March. So you can see a slight difference from the earlier slide, is that there were 2096, right? This is end of 2019. This is March 2020. You can see another 300 ETFs were listed, okay? Or 200 plus ETFs, right? The assets is just in one exchange was 3.6 trillion. But what is interesting is this. It seems that people in the US don't trade stocks anymore, right? 63% of their daily volume actually comes from ETFs. It's almost like you flipped it upside down kind of thing. Last time, so the stock exchange will make money whenever their trade's done, right? And typically the traditional stock exchange will make a lot of money, or will make money or earn fees when people trade stocks. Now in the US, this is the NYSE. It's flipped the other way around, right? 63% of their volume is actually ETFs and not actual stocks. And if you think about it, the ETFs that they buy, then on top of that, the funds actually have to buy those stocks. I would say ETFs have very, very big impact when we talk about the stock market, right? Now let's look at Malaysia, right? Let's look at Malaysia. In Malaysia, there are a total of 17 ETFs that have been listed. Okay, and if you can look at them, you can literally trade quite a few things, like without leaving the exchange, right? So they have got commodity ones. So if you want to trade gold, you can do it here. These are equities. So if you can look at them individually, they will actually show you. You have to look at them exactly what they offer. So this one is follows the FTSE China 50, right? Top 50, I believe. This one follows Bursa Malaysia ETFs, right? So FTSE Bursa Malaysia. And this is one by Affin. It's Trade Plus. It tracks Chinese stocks, right? Or new economy, which talks about consumption-based businesses. Okay, so that's what they track. Then you've got the Sharia compliant ones, which is, if you want to buy the Dow Jones Index, you can as well. You can buy the Dow Jones Islamic Index as well. And so on and so forth. So I'm not going to read off here, but you can sort of get an idea of ETFs, right? You're right. Actually, all this stuff is actually published on their website, so you can actually get all the information. In fact, they have to get the prospectus out and everything, so it's actually quite transparent. So instead of saying buying unit trust, for example, right, where they charge you an upfront fee and so on and so forth, ETFs are a good alternative, right? And in fact, if you're used to using a portfolio, it'll be great because you just buy an ETF and you can see generally what your exposure is. All right. One of the things that was recently launched that I quite like, right, was this. I see a lot of people asking, oh, should I buy US stocks? Or I want to buy Facebook, I want to buy Amazon, I want to buy Netflix, and so on and so forth. But if you go through that, you have to go and buy and do the whole thing, and you can buy them directly, right? But what has happened is that so Trade Plus is actually by Affin Huang. They actually launched 2 ETFs, right, called the FANG Plus leverage tracker and also the inverse tracker. Now, what's interesting about this product is this, right? FANG stands for, so you go and Google, if you're in front of your computer, you can go and Google FANG Plus. Okay, what does FANG Plus mean? FANG Plus is actually an index, right? FANG stands for Facebook, Apple, Amazon, Alphabet, Netflix, Nvidia, Google. right? In the plus, they actually have a list of stocks that they track, right?
And one of them is Tesla.
Oh, one of them Tesla as well, right?
Yeah.
So just to give you an idea, this is the convenience that it is providing. So if you buy any of these, right, they actually give you exposure to these tech stocks, right, that a lot of people are very popular now. Now, what is interesting is this. They have this thing called a leverage, which means that if you put $1, and let's say it goes up 10%, in this it actually goes up twice as much, right? Of course, the inverse is also possible. So actually, for FANG Plus, which means that you can get access to US market on the Malaysian market, and you can actually go long or short. Long meaning you buy and you hope that it goes up, lah. Short meaning that you're hoping that it goes down, right? So the existing volatility that we have at this point in time, it is quite an interesting product, and I believe right now that because there are certain requirements, but I know right now all you need to do is actually go and watch a couple of videos. So you need to be a proof investor to go and check out some of these products, right? But you actually now just need to watch some videos and sign some forms. Just tell your broker, and you actually trade some of these products, right? Which I think they are pretty cool. All right. Benny, do you wanna? Oh, before we get, do you wanna talk a little bit about the 𝐀𝐿CI ETF as well?
Yeah, I'm just gonna mention a little bit because this is a new product which is just launched. Is unlike the other ETF products, right? So here, like Alvin has just mentioned, we have leveraged ETFs and inverse ETF. So on the leverage side is 2 times leverage, right? So like if you buy, for example, 𝐾LCI, right, and the 𝐾LCI index, because it tracks the 𝐾LCI, the Kuala Lumpur Composite Index. So if the index, let's say, go up 5%. The price on the 2 times 𝐾LCI will go up 20%, right? Plus minus, like not necessarily it follows fully, but it's all leverage, right? And the good thing here is you can also do a hedge if you want, right? That if let's say you think that the 𝐾LCI is going down, right, and you want to protect your stocks through hedging, you can also buy the 𝐾LCI inverse ETF, right? Meaning that if let's say the 𝐾LCI goes down 10%, the price of the inverse ETF will go up 10%. All right, so that applies to the Trade Plus HSCI or the FANG Plus index as well, right? So you can actually manage it instead of trying to go and if you want, you can go to the futures market where you get bigger leverage, right? But here you can actually trade on the stock market itself, on the Bursa market, on Bursa Malaysia itself, to track the index, right? So the good thing about leverage is, of course, it's a double-edged sword, right? But it basically gives you additional margin, right? You buy an ETF, for example, a 2 times leverage ETF on a 𝐾LCI, the index goes up 10%, but you make 20%. All right, it's a double-edged sword because if you got it wrong, of course you can go the other opposite, lah. The index can go up 10%, or if let's say the index come down 10%, then you're going to lose 20%. It's an interesting product for those who are trading as well, because you get that kind of volatility in the markets. It tracks the index, right? So it's quite easy to follow. If you are someone who is still new and do not know what to do, what stocks to buy, right? And the index is always available to anyone. We all know the index, right? Every day we hear about index close how many points, go up how many points, go down how many points, right? So that will give you an alternative, right? And not only that, because you don't need to buy, like Alvin said, the whole basket of stocks that make up the 𝐾LCI, right? You just pay like a share you buy on the stock market, and then you can have exposure, right? And the good thing is, if you have money, you can actually expose yourself in the Malaysian market. If you want to expose your investment in the US market, then you buy the FANG Plus, right? And you want to expose to the China markets, you can also go into China markets or even the US markets. Right, so with a pool of funds, you can actually divide your funds into these ETFs. It's basically giving your money to these fund managers, and these fund managers investing you in different countries. All right, Calvin, just explain the 𝐾LCI one, so you can continue. Alvin, I think your mic is mute.
Oh, sorry. We're getting some questions that's asking how to buy. Actually, you can buy them just like normal stocks, right? So if you have an online brokerage account, you can just log on and you can buy it, right? It's quite straightforward. And also, just go to your thing and then search for it. Like, you guys can go and download these slides later, and if you look at this is actually the stock code. So you can go and search for some of these stock codes. Hang on. No, some of them are, some of the stock codes are here, so you can actually go and search for them. Yes, these are the stock codes, so you can search for them and you buy them like any other stock, right? It's the same, right?
Yeah.
In my opinion, I mean, I know a lot of ETFs will say that, oh, I'm cheaper, or it's cheaper than this. I think the whole point you want to go in ETFs is got nothing to do with cheap or expensive. It's really just convenience. That's it, right? It's like your 7-Eleven store. You know the same product can be cheaper somewhere else, but you go there because it's convenient, right? So that's really what ETFs are. Okay. So you can, but of course, this leverage and inverse ETFs are leveraged, right? And I think there was a question here from Shamin to say that, is there a time limit? There's no time limit. There's no time limit like warrants, so it's forever. Okay. So it's not like warrants. They are funds, effectively, with the leverage portion factored in, which you actually don't want to go and borrow that money. It's all factored into the fund. They figure it out, right? So convenience. So they worry about all the difficult stuff. You just buy and sell. That's it. Okay. But I like, or maybe because I'm a millennial, but I do like FANG. FANG is something that I can relate with. And if you think about it, nowhere in the world can you buy a Facebook or Amazon or Alibaba, or well, now you can't buy Alibaba in the US anymore, but or soon to be delisted. But you to get access to some of these stocks, it's a very convenient way. Instead of going there, setting a brokerage account, and someone mentioned there's withholding tax and so on and so forth, right? So if you don't want to have all that headache, then this is the easiest way to do it. Okay.
Yeah. Imagine buying one Tesla stock is already $1,000 currently, right? Just one stock. It's just 4,000 over ringgit.
Yeah, exactly. Then you gotta go and transfer your money. You gotta create an account. Then you gotta go and figure out the bank. Then the bank is a bit painful. It asks you to transfer money, and then you gotta worry about forex. It's just very high. I mean, high barriers to entry. So this is a very low barriers to entry. So you don't have to worry about forex or anything else. Whatever it is, all reflected in the share price. Okay. Yeah. Okay. So actually, so there's a question here from PT Lim. I heard that not all brokers can buy ETFs. No, all brokers can buy ETFs, except for the leverage and inverse ETF. They make you do they ask you to go and watch some videos online before they can approve you to trade it, because to make sure that you know what you're doing, and it's a leverage product, right? And I think this is only for limited time. So I strongly suggest go and get your account set up, everything, right? Because do it now. Don't wait till the market crash, then everyone rush to go and buy, right? No, set up all your systems ready to go, and when it's ready, when you're ready to trade, then that's when you go in. Yeah. Sometimes some of these administrative things can be quite painful. Okay. So I got a question here. ETF, not much volume traded. Okay, so I'm gonna come to this is my next slide. Okay, now, so remember in my previous slide I showed you that actually for the NYSE, 63% of their volume is actually ETFs. Let's look at Malaysia. So I took out all the statistics. This is actually from Bursa Malaysia, and you can see ETFs have been around for over more than 10 years, right? I just want to share with you, these are some of the statistics. It is last quarter 2019, third quarter 2019, it was 0.03% of value traded. Fourth Q was 0.03% volume traded, and 1Q 2020 traded. Okay, now unlike stocks, okay, in terms of volume, ETFs are effectively open-ended, which means that there's more people buy it, more funds come under management. So the volume is slightly different in a sense that they actually have what they call market makers to put the bid and ask for you, so that you can buy and sell. Okay, so you're right in terms of popularity in Asia or in Bursa Malaysia. We're not seeing that is as popular as other as the states, for example, right? And I guess that's why the exchange or Bursa is also trying to sort of educate people, to explain to them what ETFs are, right? My point is this, right? A lot of people in Malaysia or trading Bursa Malaysia still like what you call, Benny, play stocks.
Play stocks. That's a problem.
It's not an investment mindset. It's more of a very speculative kind of mindset, right? And I think that's why the popularity is not as what we expect it globally to happen, right? So I guess as you guys, I mean, this will be good for investors, right? If you're a day trader or you want to speculate, right? These are not. No one will want to trade these products, right? Because it's very much for investors, right? So since not much, so Benny, I think you worked with some ETFs on this, right? Since not much volume is traded, will the market maker buy it back?
Yeah, I guess a lot of people worried about the volume, right? Because when you look at the trades, it's like not many trades being done. But you know what? All these people who actually provide these ETFs, they actually have market makers behind them, and the market makers have to make sure that their funds are truly reflected, right? With the underlying. So you have to read at the prospectus, right? Some of them, they actually buy directly the stocks themselves. Like for example, FANG and HSCI, they actually hedge it through the futures market, right? So whatever it is, they will always try to make sure that if the index, for example, the FANG index, there's a FANG index that you can actually track, right? If the index goes up 10%, that their fund is reflected the same as well. So they always have to make sure. So you will not have any hanky-panky price on the ETFs, right? So you're thinking that if you see a queue of 100 lots there waiting to sell, and you buy the 100 lots and that's it, no more. No, it will not happen that way, because once the 100 lots is finished, the market makers will make sure that another 100 or another 200 will be there, to provide the liquidity. So they are there to provide the liquidity, and we do not need to worry about it, right? And we have also talked to actually, Afin Huang earlier, that if let's say like you have accumulated a lot of them, and you wanted to sell, right, and you find that the market, on the queue there's not much volume, you can actually contact them directly and make a deal with them, right? And they will get the buyers from you. Or if you want to buy a lot, you can also contact them, right? And they will do the deal for you as well. So I think the only problem right now is, I think a lot of people, when they see that there's no volume in the ETF, they got scared, right? That they say after they buy already, they cannot sell, right? So I think that's not a worry lah. So volume is actually not really a problem, because like we said, the market makers are there to make sure that these are being fulfilled, all right?
Yeah, I you gotta think of them as, I mean, in lack of better word, like a unit trust fund. Okay, so you can buy as much unit trust as you can, and you can sell it, you can redeem it, right? So it's almost in that kind of way. I think there was a question regarding what is the spread. I think different ETFs have different spreads. But if you look at the FANG, it's gonna be less exciting. I tell you why. Because when the US market closes, then we start opening. So there's only ever gonna be one price at the end of the day, right? So you got to factor in some of these differences in terms of timing as well, right? So you can see they are not very popular here, because I guess that's why we're doing some kind of education here, just to educate. And I guess that's why Bursa wants to educate people on what ETFs are. I believe they also hope that that kind of volume would come with ETFs as well. But I think Malaysians still quite like to buy their own their own stocks, right? But there is some volume, right? I think in the last, for example, let me give you an example why I think ETFs can be quite helpful. I know when gold started moving, instead of you going buy physical gold, right? It's just much easier to just go buy the ETF, because you only want to leverage on the price difference, right? You don't really want to go to, let's say, your retail gold shop to go and buy gold, store it, secure it, transport it. There's going to be transaction fee as well. So really, I think that's where ETFs can be quite useful, actually, because it's just a financial instrument, right? It really, really, really helps with what I call convenience. All right. Okay. So my next topic here is actually REITs, and I think most of you guys know what REITs are. We'll definitely do the Q&A later, right? So if you guys have any questions, just keep posting at the bottom, and we'll talk about it, right?
Okay, before we proceed, sorry, Alvin, before we proceed, we're just going to start a poll. It's just going to ask you whether you guys have already bought or sell any ETFs. That means you have traded any ETF. Just answer yes or no. The poll will come up on your screen, right? So you can just answer while Alvin continues. Thank you. All right, Alvin.
Yep. Okay. Cool. Right. So okay. So let's talk about REITs. REITs very simply is okay. So how many REITs are there in Bursa Malaysia? Right, 18. Right. As of today's session, there are a total of 18. And actually, you can download these slides. This list is actually from Bursa Malaysia. So so you can actually refer to this anytime. So let me go next here, okay? Now, just like the FBM KLCI, where we talk about all the stocks that we have, the top 30 stocks in Malaysia or the composite index, there's also a REIT index, right? So REITs really is grown. It's about 18, so it's very close to ETFs. ETFs 17, REITs are 18, okay? REITs are the same, except that they are also run by managers or fund managers, right? In a very general term, fund manager, but they are actually property managers. So they will go and find a property. They will go and find the tenant. They will go and lease it out. They will do everything, so you don't have to go and buy this property. And in fact, why it's also convenient is that, typically if you're going to buy a building which is a couple of 100 million, right, an individual person may not be able to buy it, right? So the whole idea about pooling your money together and buying a percentage or piece of that property is what they call, it's almost what I call fractionalization of property, right? So with $100 or $150, you can buy any REIT, for example. Now, I'm going to share with you some very interesting stats about REITs. So do stay tuned. There is more stuff coming in. Okay. Now, generally in Malaysia, okay, I know very recently everyone started asking about data centers, right? Data center REITs. They also exist, but they're not listed in Malaysia. Okay. So I'm going to talk about the Malaysian ones. Okay. Very simply, you've got 5 or 6 main types. Okay. You got the retail guys, which is shopping mall, right? You got industrial, which is they rent out industrial space for businesses, right? Then you've got office space guys, right? You have healthcare, you've got hospitality, which is tourism or hotels, right? And then you got Diversify, which is they own education, they own campuses, colleges, they will own shop houses, they will own a few other things also diversified, right? So you can't really see the whole. You can't diversify means they don't have one specific sector. All right. What I've done in my slides here was actually this, right? So I actually went through the REITs, and I wanted to show you how they look like and their performance. Okay. Of course, there is a lesson behind this, so I have mall REITs, right? Shopping malls, okay? Mall REITs, there are 1, 2, 3, 4, 5, 6 shopping malls, right? And if you look at them, what we did was I actually pulled out all the times when they were first listed. So each of them were listed. So 2006, 2010, 2011, 2012, right? How long they've been listed, okay? And what is their share price return as of today, okay? Now, you're getting some mixed numbers here. In terms of share prices, right? 3 of them are down and 3 of them are up, okay, as of today from IPO, okay? Now, but what I want to show you is this interesting one here, right? Now, REITs are essentially, you're getting exposure to property and you get income through rental. Okay, so REITs generally, according up to the mandate, they need to pay out 90% of their rental income. Okay, so you're guaranteed a dividend. As long as they rent it out, the money will come to you as a shareholder or as a unit holder. Okay, now if you look at, for example, the first one, income distribution, that means if in the 13 years, if you have held this stock for 13 years, right? It would have, in terms of dividends, if assuming you invested $1, you would have gotten back $1.32 in dividends alone. Okay, that means after 13 years, whatever you put in, you've already gotten back everything. Effectively, you can say your capital is free already, right? So whatever extra return you're gonna get, it's bonus. Okay, so that means you already gotten your capital back. Everything else is pure profit, right? Now, but if you want to calculate it against their share price return, so if you add it together, so actually in this case, even if you invested in a hectare and it looked like you made a loss of 31%, but if you held it over that period, you would still be up 100%. That means you would double your money in about 13 years. This is the I just want to highlight, because there are two very stark differences between ETFs and also REITs. Okay, now if you look at these REITs as well, because they are forced to literally pay you back whatever they earn as rental income, you're going to see that this income distribution since listing is actually fairly high, depending on how long they've been listed for. So in this case, Sun REIT has almost been 10 years now, almost been 10 years. They've given back almost 100% of your initial investment if you bought it at IPO, right, on the first day of listing. 92.6%. So in terms of whatever rental they get from what they'll pay it out 90%, this is all yours, right? And if you look at, of course, if you look at their return versus their share price return plus their income distribution, then you're gonna get a very decent return, right? Okay. Of course, CMMT is Capital Malls Trust, which is Singapore owned. You're gonna see that it is, even they have made a loss on the share price, actually whatever dividends they get back is 78% of your capital. So I want to give you an idea what this means. It's actually quite sizable, right? What they pay you back. Of course, this Pavilion REIT is 8.5 years. They pay you 63% back. This is IGB, which I think you know, the famous I'm slipping Mid Valley, yes. Mid Valley. Yeah, 45%. And these are all their returns, right? So these are shopping malls. Why are these fairly easy investments as opposed to investing in stocks? It's because you can literally go and drive and visit their property, right? And you can see how well they're tenanted, and whether there is foot traffic, as when we talk about shopping malls, right? Because shopping malls, their rental is can be two ways. Either it's fixed rental or it's a percentage of the revenue from the shops, from their tenants, right? So of course, the more revenue, more people go and shop there, and they actually earn more, right? So that's why you're gonna see a discrepancy, slightly different in the business model, right? But these are all backed by properties, okay? So I want to give you guys an idea. This is what the share prices look like. You can see, they're up. Now, even in a period like this where things are down, some of these stocks are still up, okay, from the IPO price, right? So you can see. So I've actually put it in my slides so you guys can actually download this later on. In a very, very short while, you can actually download it. All right. I'll give you guys the link. Now, the second type of REIT that we have in Malaysia is what we call industrial REITs, right? So of course you got Axis REIT and Atrium as well. Okay, so these are two, and they were both listed 14 years and 13 years here. Now Axis REIT is actually by far the best performing REIT in the whole industry here. In terms of income distribution in 14 years, they are pretty good property managers, right? They gave you back $3 for every $1 you put in terms of just pure dividends, right? Pretty good property managers. And of course, the share price has gone up 146%, right? So collectively, you would have made 4.5 times your money in 14 years if you bought from IPO and did absolutely nothing. All right. Now, if you talk about Atrium, it's the same thing. 13 years, 13%, and then it's again, you see they give you back 100% of whatever you've already put in, and then your total return on losses. Okay. Now, so you can see again the share prices. So if you guys want to have a look, you can check out the share prices. Now, this is for office REITs, right? Office REITs, there are 1, 2, 3, 4, 5, 6. Okay, so of course, when we all think KLCC, we think KLCC, the shopping mall. No, actually, it's KLCC, the shopping, not the shopping mall, the office, right? It's also, I think they own Menara, ExxonMobil as well, which is right next to Traders Hotel. And I think there's one more one more major. I can't remember off the top of my head, but KLCC is not Surya KLCC shopping mall. Okay, it is the office. This is what they've returned, right? So you can see even a lot of these guys, even their share prices have come down for whatever reason. Historically, their dividend that they pay out, actually it is quite sizable when talk about returns on investment. So these are all investment products. These are not speculative products. Okay, so you don't want to day trade any of these stocks. Okay, for example, right? So these are all here as well. So you get 𝐸𝐭 REIT, you get 𝐸 KLCC, Tower REIT, UOA REIT, AHP, right? Of course, you're gonna ask me what to buy, what to sell. You know, I cannot advise you guys. But I guess if you look at common sense, if you're looking at stocks that have been beaten out very, very badly, and if they have still got decent assets, I think they will still do okay, right? So these are very much long term. This is healthcare, which is KPJ, right? There's really only one. But if you look at it over 13 years, they're about the same range. So actually, they, in a way, if you look at REITs, if you buy them long enough, right, you're actually going to get your capital back. The question is, how long is it going to take? Okay, and your bonus effectively is actually your share price movement. Okay, of course, this I think it's my second last one. But if you can look at hospitality, obviously they are not going to be doing well. So I think someone asked me about AR REITs here in terms of hospitality. So YTL, as you all know, I cannot remember off the top of my head all of them. You can actually go and Google and you can find out a little bit more about where their location and so on and so forth, right? Okay. Yeah, actually that is my last. So actually I did a summary. So if you want to look at REITs, right? This is a summary, right? So I've highlighted the top 4 in terms of return. Number 1 being Axis, and I actually did a compounded return as well. I know it might be a bit too small, so I'll just read it out. Let me see if I can zoom in. Okay, now Axis REIT, if you're purely looking at since IPO inception till as of yesterday, 19th of June, you're looking at a 12% CAGR, right? A very simple way of calculating CAGR. Next is actually Sunway. Sunway, I think you all know Sunway Pyramid. If you're not from KL, go and Google it. They're a destination mall. And the next was actually Pavilion, which is about 10% compounded return, and IGB. Now, what was interesting about all 18 of these stocks, all 18 of these REITs, actually over the long term, only one lost money. Only one has lost money, right? And if you think about it as an investment risk profiling, I mean, if today I can show you 900 stocks, how many have lost money, I can tell you the percentage is going to be much higher. What is interesting is that even if these companies today at down markets actually have lost money in terms of share prices, a lot of them have way over compensated with the dividends that they actually pay out, right? So my thought process behind REITs is very simple, right? So remember I talked about, if I go back to the beginning, if you're running a second lifeline, and if you're too busy to do anything, right, and you don't want to go into stocks directly, you don't have the time because it does take time, then you want to let fund managers handle it, for example. Okay, so either it's a property manager or a fund manager, for example, right, that invests in other stocks, right? If you look at REITs, for example, it's not about buying today and selling in the next 3 months or 6 months, right? REITs actually give you value creation over the longer term, right? So it's almost, you got to think of it, if you're not going to buy a house today, you're not going to go and buy a property today and sell it 3 months later and speculate on the price. You really shouldn't be doing the same with some of these REITs as well. So these are very much long term. You're gonna get those returns actually over the long term. So that's really my message for you when you want to decide to invest in either a REIT or actually an ETF, right? Both have different users. At the end of the day, they are created for a specific purpose, right? It may or may not fit you, right? But if you look at REITs, the returns, you're not going to get a 25% CAGR, right? Okay. but I also don't think, you know, there's a very high chance you will actually lose money in the long term. Not this is my personal opinion. And if you look at the stats, really 1 out of 18 have lost money, and some of them have been more than 15 years. You know, right? Just to give you guys an idea. All right. Okay. So Benny, you wanna do a Q&A?
Yeah, so that just do a little bit of a sum up of what just being discussed, right? Of course, if you look at the results in the long term, you know, the results are really it's not bad, isn't it? I mean, it's still better than putting your money into FDs if, let's say, you buy them, and especially REITs, right? Like Alvin mentioned, only one of them has actually lost money in the long term, and that loss is not really that big anyways. Not like when you speculate in stocks. But the good thing, I think one of the key takeaway in when you are investing in ETFs or REITs is it has to be long term, right? Because you'll be getting dividends, and that dividends itself will lower your risk over time, right? So that's very important. You can't buy today and sell tomorrow, speculate on price. You know, if you're going to do that, maybe it's better to do it on stocks, right? Because ETF, even if you look at the share prices, they don't move as volatile as this other stocks, right? Because they are actually a fund, and they have a portfolio of investments that they do, right? So it's not like any other stocks. So it's really, you know, the price doesn't really move that much, not volatile. So it's really good for investors actually who do not like volatility as well, so that you can sleep at night, right?
Yeah.
And you know what, because the products are there, right? And imagine if let's say you have 2,000 ringgit lah, right? You know, if you buy ETFs, you can have an exposure in US markets, you can have an exposure in China markets, and then if you want to buy REITs, you can have an exposure, let's say lah, I'm not saying, and I'm not giving any priority or whatsoever, but you know, you can be exposed in Mid Valley, for example. You can be exposed in properties in KLCC, for example, right? So with that, like 2,000, 3,000 ringgit, you actually have a portfolio of a lot of investments, right? So like Alvin said, it's like a 7-Eleven. It's like more convenience, right? Instead of you having 2,000, 3,000, trying to figure out what stock to buy or what stocks to buy, and with 2,000, 3,000, you know, there's not much money, there's not much stocks you can buy anyways, and how to create a portfolio and so on. So this gives a very easy entry, right, to those who maybe want to start, or even if you already are investing, you already have a portfolio, you may even add this into your portfolio as well, right? Because like REITs gives you a exposure into the property market, right? So you're a property investor. I always joke about it, you know, when we talk about REITs in workshops or seminars, right? That, you know, if you bring your friend, for example, you own Pavilion REIT, right? You bring a group of friends, go there, and then when you leave, you tell your friends, thank you for coming, right? Because you partly own, right, Pavilion. Yeah, so it gives you exposure into a lot of asset classes, right? That's where you can diversify. Of course, if you want to be safe about the returns, is better to go long term. Yeah. Okay, so that's my sum up. Yeah, maybe we'll take questions for now. Anyway, we're going to come up with another poll, right? Have you invested in REITs, or you bought or sold shares, or bought or sold REITs? The question will pop on your screen in a short while. But the results are out for ETF, right? So we have 13% of the audience have bought and sold ETFs, only 13%, right? 87% have not, right? So maybe after today, if you consider that, you know, maybe you want to give it a try, please do, because, you know, the risk is up to you, right? You can start small first, and then later you can add up. Because once you know, a lot of people know about ETFs. ETFs can be as big as in the US, right, where like 67% of the volume being traded. Even fund managers buy ETFs, right, in the US.
Yeah.
Yeah, so it's crazy big, lah, you know. So that's the reason why you know, Bursa wants to promote this product as well, so that you basically know what products are being offered, right? It's not just the normal stocks or warrants and all that we have, but we do have this product so that you are more you get more options, right? And with the little fund that we have, you can have more exposure in different markets. All right. Okay, so let's take some of the questions. Okay.
You want me to put up the link where they can download and just get the feedback as well?
Yes. Okay. Fantastic. Yeah. So if you want to download the slides, we're going to put it on our comment section as well. We're going to pin up there so you can get the link. Okay. You have to go to the link that's on your screen right now. But you have to answer some of the questions first. This is actually an evaluation and feedback question. So you have any, you know, if anything that you want to tell us, or even tell Bursa Malaysia on how to improve this or whatsoever, or any comments, there's actually an avenue for you to do that in the comment section in this form, right? So once you have completed the form, then an email will be sent to you to give you the link to download the slides. All right. So make sure you enter a real correct email. You know, if not, you will go to someone else's email. All right. So please do fill up these questionnaires, this evaluation form on the link that's in front of you. Okay.
Yeah. If you like us, don't like us, you don't want to see us again, or you want to see us again, put it in the comment below as well.
Yeah. Or any suggestions that you have, also you can put it up.
Yep.
Okay. Okay, I'm going to bring up a question.
Sorry, go ahead.
Yeah. So there's a question here by Chong CF, right? Top performing Malaysian REITs are shopping mall focused. In other markets, shopping REITs are longer popular. What are your thoughts going forward for shopping mall REITs in Malaysia? I think the question meant to be like other market shopping REITs are no longer.
Yeah. I think actually the top performing one was not a shopping mall, it was actually an industrial REIT. Yeah.
Industrial, right? Industrial, no. Not those office spaces, but industrial office space.
Yeah, it seems, yeah. I look, to be real honest, if you look at the retail landscape, I'm still trying to understand it, right? Because in most Western countries, if you look at shopping malls, you know, they are not popular, right? Somehow. But I think in Malaysia, it's sort of become a lifestyle. It's almost become cultural, you know. You know, I give you guys some very simple examples, right? If you look at COVID spikes in Europe and US and UK, right? It's crazy, right? If you ask me, I'm asking why. You know, I ask myself why, and one of the things I realize is this: their culture is actually very different, right? It is about being liberal, about being free, right? Some of these European countries didn't even have a lockdown, right? And it's very much a cultural thing, whereas us, you know, or in China, you know, yeah, okay, whatever government say lockdown, okay, we pandai listen, and then we just stay at home kind of thing, right? You know, no one's doing protests or having a party outside to protest why we're on a lockdown, because everyone understands, right? So I think in the same instance, I believe for a lot of shopping malls, they are no longer popular in a lot of the Western cultures, example, right? Because online shopping has taken over, right? Or is a very much large part of their culture. But you know, it's tough because I you know, if you look at sometimes, you know, when I drive past shopping malls, I don't get it because you know, people rush there to go there early to get parking, you know, because they're gonna spend the day there, right? That is the actual excursion to be there, right? So I'm a bit 50-50 because I think this is very much you know, I think it's gonna be very much a cultural thing. Now, of course, when I talk about shopping malls, is the bigger ones, right? You know, I think back in 2018 there was something like 50 or 100 new shopping malls that were launched, right? I think the smaller ones will probably won't survive. But it seems like the destination type malls, they will do well. You know, like if you have a theme park, you have a hotel, you have a mall, it's very much the surrounding, right? That actually creates that buzz, right? You know, but if you're just purely a standalone shopping mall by itself, it might be a bit tricky. Yeah. So because it will be very much a destination shopping mall, right? So I guess if you're in KL, you know, if you're talking about those individual small ones, you realize that a lot of them are very hard to survive. It's the bigger guys who are almost a tourist destinations. They do pretty well. Yeah. So those are just my thoughts about mall REITs.
Yeah, I guess it's like it's also like an entertainment place for even families, right? Because most of these big shopping malls, they have cinemas there, they have play spaces there, and they even have the adults with drinks and coffee, and so it's like you spend one whole day there. It's like a whole family playground, lah, right?
Yeah,
air conditioned some more.
Yeah, yeah, free air conditioning, right?
Okay, yeah.
I think there were some questions regarding REITs. You can just buy REITs on your any trading account connected to Bursa. It's just like any stock as well, right? So after you download this list, you can actually also see You can look for some of these stock names and you just buy them like a normal stock and you receive dividends like a normal stock as well, right? Yeah. Okay, so that's
it's the same with ETF also lah, right? It's normal stock.
Yeah. In terms of, I think some of you guys are asking, can I just log on to a broker in Malaysia and trade US stocks, US ETFs? No. So ETFs are listed on their own individual exchanges. So if you have access to another stock exchange, you can trade whatever stock exchange ETFs there are. But if you're in the Malaysian stock exchange, you can trade the 17 ETFs that I've spoken about.
Yep.
It's convenience. Okay. Yeah.
There's a question whether there is a data center REIT. Right now we don't have lah, right?
I think the closest, okay, off the top of my head, the closest you can get to some form of data center, which is not a REIT, okay? It's a stock. It's actually time.com. I know in their portfolio, they have data centers as part of their portfolio, but it's a very small part of their revenue. I mean, not very small, but it's a smaller percentage part of revenue. But in terms of a data center REIT itself in Malaysia, we don't have one.
Okay, we have a question on REIT as well. Daniel too is asking whether this is IGB is about to announce an IPO for another REIT, probably even the end of this year. What do you think?
I'm not a REIT expert to be real honest. I'm more of a stocks guy, but I think for the destination malls are, I think, like talking about Mid Valley, and also Pyramid, right? If one of Tama had a REIT, one of those, they will still strive. I think the big 3 or 4. I think the smaller ones are gonna find it very challenging.
Yeah, I think that's the beauty about REITs as well. But like you said, right, because it's a brick or mortar, you can actually go there and see, right? So I mean, when they want to launch a product, a REIT product, you look at the prospectus, find out where the locations are, where the properties they're investing, to get a feel, right? So that at least you know whether it's worth investing or not. Like Alvin just says, it's pretty much common sense, right? If you go to a mall where you don't find any parking after, let's say 11 a.m., that means there's a lot of people there. They will not go out.
Yeah. And the mall revenues or rental revenues can be a variable as well, right? So when in good times, they will do better. Yeah.
Right. Yeah. Okay, we have a question from Jason Wong here. Basically asks how to ensure capital preservation versus dividend income when investing in REITs.
How do you ensure capital preservation versus dividend income when you look? I think if you look at the track record of MREITs, and I think we have a long enough track record, some of them are 15 plus years. It seems as though that you're not going to get a 4 times, 5 times, 10 times returns. I don't think that's going to happen, versus stocks, right? But you're going to get very consistent dividend income. So as long as they can maintain that property and the tenant is still there, your capital preservation actually comes from your dividend income. If you look at it, right, versus capital preservation versus dividend income, I think capital preservation will come from having dividend income, right? So I hope that answers your question.
All right. Let me see if there's the same question. I mean, there's another question as well. The figures in your income return that you show on your chart, has the withholding tax been excluded?
Well, I gotta check. I can't remember off the top of my head. I can't remember. Let me go and check, and I'll maybe update the slides as well.
Right.
Whether it has or without doesn't have. But I believe it's already net of taxes. It's net. Off the top of my head, I believe it's already net of taxes. Yeah.
Okay. Okay, this one is more on a forecast. You wanna take it? This is by Colin, right? Asks, how do you see rental dividends for retail and office for the next half year given the current situation?
I think for offices, I mean, even like us, we are locked into a contract, right? Typically 3 plus 3 lah, 3 years plus 3 years. I think if depending on the tenancy agreement of the REIT itself, if a lot of them were maybe signed on last year, I think a lot of officers have no choice but to continue with it. But will they continue? I think going forward, I think looking at what's happening with post-COVID, I think a lot of officers are now rethinking the whole idea of having a big office. Do they actually still need it? And could they be just as effective working from home? Now, of course, general offices are right. It depends on the business, right? If you're saying a bank, then it's not going to be possible, right? But I think most industries will find it okay, especially offices, to be able to work from home. So which means that office space, they will rethink and think, do I actually need that much space now, right? And then there could be potentially oversupply, but in terms of office space, it's just too generalized, and that's really the problem, right? If I talk about office space, you must sort of look at location and what grade they are, right? And you must look at the prevailing rates, right? So if you look at grade A offices outside of KL City, and I only know this because we had to do a lot of shopping around to figure out our new office space. Actually, there was a lot of demand for grade A outside of KL, right? In fact, some prices were even higher than KL itself, right? So you must look at the location, right? So if you're in PJ area, you can charge even just a tad below KL prices, and people will still pay, right? Because a lot of officers are shifting out of KL. They don't want to be stuck in the jam. They don't want people to be stuck in the jam. So I think office is just too general. You need to look at where they are located. Yeah.
Right. Okay, we may have time for one or two more questions. I think we'll take one of these questions. I think this is quite important as well. So Andy Tan is asking, is dollar cost averaging suitable for REITs?
I'm not a big fan of dollar cost averaging. So because I don't believe in buying at time periods, rather you need to buy at valuation, right? So I will still stick to my guns and saying that you should still buy on valuation rather than on dollar cost averaging. Although if you look at the sense, although we did say that we are lower volatility for REITs, but actually I don't think so, because if you look at what has happened for some of the REITs, they've dropped 30-40% as well, right? So there's still some sort of movement in it, right? Isn't completely flat, right? So although after this presentation, just purely looking at numbers, you think that it's quite flat lying, but they're not. If you look at them, they actually do move up and down as well. So I still don't think that dollar cost averaging would be a good move, right? So I show you guys some price charts. Nothing is ever stagnant, it's not flat line, right? Okay. So of course the returns today that I'm using is based on 19th of June 2020, right? Things can change in the next 12 months, 18 months, right?
Yeah. So if you only want to go for the dividends, then yes,
Yeah. But the dividends actually do come out to quite substantial amount over time. That means you're not ever gonna get multi-million-dollar rich just by investing in REITs, for example. But they form a very useful part of as your portfolio lah.
All right.
Yeah.
Okay. There's a question actually from this is not related to it, but will there be a webinar for stock trading newbie? Bursa Malaysia is actually bringing these sessions. We have another 8 sessions after this, right? This is a second session. There'll be a first session earlier. So if you missed the first session earlier, just look at the recording. All right. We still have it on our Facebook, but please do it. Please do it fast, because it's going to be taken off. Once it goes to bursaacademy.com. So that brings us to our next part. Maybe Alvin, you want to show that slide where Bursa Malaysia has actually come up with a new platform, right? E-learning platform called Bursa Academy, right? So you can actually go to www.bursaacademy.bursamarketplace.com, or if you forget, you just go to bursamarketplace.com and you should be able to see Bursa Academy in there. So this is where you get e-learning videos, and even the videos that we have it here is going to be up on Bursa Academy as well. All right, so please do log on to their website. All right, so I think it's about time we can wrap this up. Alvin, is there anything that you want to mention before we
that's it, yeah. We're here every Saturday, so don't forget, next Saturday 8 p.m. do join us, and of course to all the fathers out there, happy Father's Day.
Yep, happy Father's Day, and we'll see you again next week, right? And please don't forget to download the slides. The comment section we still have that link on the comment section. It's pinned up there, so please do fill up the short evaluation form, and then you should be able to download your slides. All right.
Yeah.
So guys, thank you very much for joining us. We'll see you again. Have a good weekend, and good night.
Yeah. Thanks very much.